Today we're gonna actually be looking at the end of month report, or in this case, the Q3 report that we just released this Sunday. And usually this report's only visible and only accessible for people that have the Elite Collection. But today we're going to walk through the report for free, so everyone can see the insights from the report this time. And this report we basically release every month, and in this report we basically highlight what has been happening in the past month from a fundamental level as well as a technical level. We go over different markets. The reports are posted in the 2 Degrees library. So if you go to wop.com/2 degrees, it will say open 2 degrees in the top right, and then you'll get a menu on the left side, and then you can click on Elite Collection Library, and it will be posted in there. All of them are posted in there. And for the people that do not have access to the Elite Collection, I do want to say the older reports are being uploaded to the free library as well. So you're all able to see the older reports that we posted at the start of the year, just so you guys can see the insights. But the live reports are only available to the Elite Collection subscribers. So keep that in your mind that, you know, the Elite Collection nowadays is not only just indicators, but actually we've expanded the Elite Collection a lot more, and it's not only indicators, it's now also these reports as well. So good morning, how do I pronounce your name? Abhishek, is that correct? Anyway, good morning, hope all is well. Where's everyone from? Is it morning for everyone? For me it's not morning. For me it's 3 p.m. So 2 p.m. Extinct Silk. Where are you from? UK or 2 p.m.? UK, yeah, I thought so. 1 hour behind me. I'm Amsterdam time, so I'm 1 hour in front of you guys. Good morning or good afternoon, Panos. Greece, it's 4 p.m. now, so it's like 1 hour in front of us. Uni library now, studying for a test. What kind of tests have you got coming up? I hope you studied well though for the test. One module of biomedical science. Sounds sounds difficult, man. From France. Good afternoon, Yasmin. Hope all is well. Bonjour. Oh, look at him. He's actually studying with the study notes in front of him. Let's go. Well, I hope you studied well enough to be able to sit inside the stream as well. So yeah, as I was saying, today we're going to be looking at this report, and we'll be going through the entire report. Don't judge the writing. I won't. I won't. Don't worry. And let's see. It's a bit slow for some reason. I cannot scroll properly. Let me see. Should function. Yeah. So, as a first, in all the reports, you'll see an introduction, and in this introduction, we basically give, or I basically give, a very short overview of what happened in the last month. Right. So in September, I just try to give a highlight. So if you only read the introduction, you kind of get an idea of what happened, right? It won't give you full details, of course, but you'll know what happened throughout the month. So in September, futures advanced broadly with NQ, ES, and YM all setting new all-time highs, and the Nasdaq 100 was leading in this case. On the forex market, it was kind of mixed because DXY finished flat, Euro USD ended up going slightly higher, and the GBP USD closed lower, right? So Euro and GBP did not go in the same direction in September. So that produced SMT divergence on a 60-day view. And the Treasury futures showed a long end leadership, meaning that the longer term bonds were leading, against the shorter terms. And it says, throughout these pages, we apply relative strength analysis, seasonal tendencies, technical observations using free and Pro Plus tools to highlight key behaviors and structural shifts that defined Q3. Then, as you can see, the report is structured into different categories. We first look at key developments in the overall stock market and general markets and financial landscape as a whole. Then we'll zoom in on the US indices, looking at the results, performance, technical analysis, and fundamental analysis. Then we look at the currency markets and we apply the same thing. We look at the results, the performance, a technical analysis, and a fundamental analysis, right? So that gives you all the information you need to get a sharp view on what's been happening in the markets and what you can expect in the coming month, right? Then we look at the bond market. Because we're doing an intermarket analysis, we need all three to see how the entire flow of money goes in the market. We need to look at all three, of course. And then there's a small appendix with some additional resources that you can look at and a conclusion, right? Any questions before we begin, before we look into the report? Now's the time. You can also ask questions during the stream on whatever page we are, and I'll try to explain anything that will, come past. But if there are any questions up front, just let me know. Let's see. So, first things first, upcoming events. And on this page, we look at all the upcoming events that we have for this coming month. In this case, as you can see, I've crossed out unemployment rate and non-farm payrolls here, and I've added them here because they might appear this Friday due to the US government shutting down. That's something we're probably all aware of. US government is closed at this point, so all the bureaus that collect statistics and distribute them, they're also closed, right? So there's no data to be shown to us. So as long as the US government is closed, this will just all get moved up. We don't know when it's going to be done, but when this report was made was the 1st of October, so then we already knew that the government was closed, but we didn't know if they would open again this week. They're still closed, so this will just move on to the week afterwards until everything is up and running again. And then we look at some corporate earnings that we have. A few notable ones being Goldman Sachs, Netflix, Tesla, Microsoft, Alphabet, which is Google, then Meta Platforms, which is also known as Facebook, and Amazon. Those are pretty much the notable corporate earnings so far. And personally, the most important economic event would be the federal funds rate and FOMC statement and press conference at the end of the month, right? In 2 or 3 weeks' time, we have another FOMC meeting coming up. Then, recent events. The most notable recent event, of course, being the US government shutdown because of a funding standoff. So, what happened was there was a fight, basically, about the budget from the US government, and a large part of Congress voted against borrowing more money to keep the government open, so they had to shut down partially. Still doesn't mean that everything is closed down. Like, the most important things, I think, are still open. For example, hospitals or whatever, or police, all that kind of stuff is still working, of course. But yeah, in the near term, that mainly means some government data, such as jobs or inflation reports, they can be delayed. And some non-essential services may pause, and overall policy uncertainty could increase because we have no idea what's going to come up next, right? Markets could react more to headlines during these periods. Stocks can swing on negotiation news, or short-term treasury bills near key dates may reprice, and sector moves can diverge, right? For example, defense, federal services, travel, they can all diverge because we have no idea what's going to happen. So until normal reporting resumes, monitoring leans on more high-frequency non-government data. What that means is there are certain data that gets released not by the government, by other bureaus that are independent. So, for example, last Friday we should have had NFP, right? But we didn't get it. So on the Thursday we had ADP non-farm employment, and that's from a different bureau that's not by the government, and we saw an NFP-like effect on Thursday, even though usually ADP isn't as volatile as the normal NFP event. But at this time, it was pretty volatile because, we don't get NFP news. Then, in September, there were 3 major central banks that had monetary policy announcements. right? First being the Federal Reserve, and this is going to be the most notable one because they finally cut the target range by 25 base points to 4 to 4.25, right? So that's the first time they actually started cutting rates again since 2024. They've been quiet all year, and now it's the first time they've done it. In Europe, they didn't do anything. They just kept it as the way it is. Japan also maintained a policy rate near 0.5%. And the Bank of England also just kept the rates the way they are. So nothing really happened there. Then a little look at some industry and sector trends. And in this case, we're looking at the Magnificent Seven. Anyone know, or is anyone familiar with the Magnificent Seven? What they are, what it is? Type a 1 in the chat if you do not know what it is, what the Magnificent Seven are. Bang. Yeah, basically it's the 7 largest companies, right? So in this case, let's see. It's Amazon, Apple, Alphabet, Microsoft, Meta, Nvidia, and Tesla. Those are the biggest 7, right? So what we can see is here the red line, being Tesla, had the biggest growth in Q3, right? Because this is the performance over in the entire quarter that we're looking at. Let me see if I can zoom in. Yeah, I can. This might be better visible, right? Now you can see Tesla rose almost 53% in Q3. So it's a pretty nice increase if you're a Tesla holder. Second one being Google. Apple and Nvidia finished almost at the same place, and Microsoft, Amazon, and Meta barely performed in Q3 and were close to zero, with Microsoft ending at 5.5% almost. Then let's go. Then something that we always do in these reports, and that I also post often inside the analyst section, is the sentiment analysis. And sentiment analysis can be pretty handy because it basically measures how the broad public views the market. If they're bullish, if they're bearish, and we can read a lot of the market emotions basically from that, right? So, and then I also highlight 2 drivers in the market that always are like the key drivers of sentiment, because usually people get scared or they get bullish or whatever because certain events happen in the market, right? They don't just get randomly bullish, they don't randomly get bearish. There's always something happening, and that leads people to feel a certain type of way. In September, the biggest 2 drivers were the policy shift from the Federal Reserve. So in this case being the Federal Reserve cutting 25 basis points, and the second one, seasonal volatility and September catalysts, right? So in August, we usually have a little bit of a choppy month, right? And typical late summer chop, and we also had that in August. And then we have September macro coming in, or macro data coming in, and large option expiries, and of course de-risking and tactical hedging rather than outright trend changing. And what we saw is that September was a lot more volatile than August, right? So those were big changes in sentiment. Then, as you can see here on this chart, right here, it shows you the sentiment index, right? And it says here bullish in the previous report was 34%, and it raised to 42%. So overall, people were more bullish in September compared to August, right? So people are getting more bullish in the market. And as you can see, bearish also barely changed, and neutral went lower a little bit. So people were less neutral and more bullish this month. Then we have something that a lot of people will probably already be familiar with, which is the Fear and Greed Index. And this is an index that's used to gauge market sentiment based on stock behavior. And in the previous report in August, this was at 64. So it was in greed, so somewhere around here. On the 29th of August, so just before September ended, we had a value of 49, which places it in the neutral category. So people are becoming more neutral in terms of fear and greed. So these two are not really pointing to the same things, which is perfectly fine because they're 2 different reports, right? Then we have something else, and this is something that we added recently. First, we only had one page on the sentiment analysis, but we recently added this one as well, which is the options and institutional overview. And of course, options are a pretty big thing in the whole trading world. I don't know if anyone in here trades options, yes or no. I personally don't. Anyone in here? Or is anyone familiar with how big options are in the trading world? Yeah, it's pretty huge indeed. A lot of people trade options in the markets, and it's also used by big players to hedge and that kind of stuff. Also with the option expiry week, indeed. So what we do is, or what I did is, was I add the put and call ratio, and basically with a put and call, it basically means, not saying betting, but expecting lower prices versus higher prices, right? That's what you can do with options, of course. And there's a ratio of the amount of contracts held, right? Are more people looking at puts, or are they more holding calls, right? Or holding more calls. And with that, we can kind of get a read on the sort of sentiment due to the amount of positions that are held. So in this case, the put and call ratio on the S&P 500 closed at 1.16. And that marks a moderate rise in the hedging demand compared to early summer levels, while still elevated above neutral 1.0 line. And the ratio remains well below panic spikes seen earlier in the year, and this suggests measured downside protection rather than outright bearish conviction, right? So people are holding more options wherein they expect the market to go lower, but because the way it's structured, that it's not a big spike or something, we read it as that people are just hedging for downside and not actually expecting downside, right? So they're just protecting themselves against sudden downside. And then we have institutional positioning, and tech and AI platforms got continued net inflows led by data centers, cloud AI narratives, leadership broadened beyond semis to select platforms, right? And then we have cyclicals, meaning those are basically assets that move like a cycle, right? And interest reaccelerated were tied to infrastructure, power equipment, commodity leverage, and position remain selective. So institutions remain net constructive but hedged at the same time, which is also reflected in the option and institutional order overview. Let's see. Any questions so far about the whole sentiment analysis? Both of the pages? Do I do this once a month or once a quarter? And do options expire every third week of the month? Yes, I do this every month. Every month you see this report, and every last month of the quarter, we'll call it the quarterly report. So in this case, September is Q3 report, but we release this report every single month, yeah. And do options expire every third week of the month? Yeah, there's monthly options and quarterly options, weekly options, daily options, and they all usually expire on a Friday. So yeah, every month there is a option that's expiring if you have a monthly option. There we go. So then we have something very interesting or very important for this week or this month, which is the FOMC meeting at the end of the month, right? And is anyone familiar with what we're looking at right here? This right here. This is the FedWatch tool. And this is basically something the CME releases. And it's a tool that's used to track market expectations for potential changes to the US Federal Reserve's target interest rate, right? So it's basically the market's expectation to any coming changes in the interest rate. And they already lowered the target range by 25 base points to 400 to 425. And now the entire market is expecting the Federal Reserve to cut down again in October, right? So here you can see that everyone is expecting the market to cut down. And what happens if everyone is expecting the markets to cut rates, people will obviously position themselves ahead of time before this happens, right? Because if people expect a lower interest rate, usually that will lead to more inflow into US indices, right? Or stock markets in general and equity markets. So if everyone knows that beforehand and everyone wants to position themselves beforehand, usually what we'll see is that the market starts to rise before the news even happens, right? And then when the news actually kicks in, the rise is not as significant as you expect it to be because everyone was already positioned. Everyone already expected it. And that's basically what pricing in means. So when suddenly, if the Federal Reserve suddenly does something that no one expected, right? So for example, holding the rates at 400 to 425, which is something only 1.1% of everyone is going for, then we'll see a very different reaction. And that's when you get those massive bearish moves, because holding rates or increasing rates is not good for equity markets. And if they would decide to cut rates even more, so let's say 0.5 instead of 0.25, that's when you'll see extreme bearish move or bullish move, sorry, because that's when the Fed does something everyone didn't expect again. No one's expecting a bigger cut at this point. And of course, in recent communications, the Federal Reserve, they said they kept the door open to additional easing, so additional rate cutting this year if inflation continues to be moderate and labor market conditions cool down. However, at this point, we don't know because once again, the government is shut down, so we don't have the data. Usually we would have had the data by now and we would have had more information, but it's just not there. So we can't really do anything with it for now, other than just go with what we already have. Let's see. Hey, this page is missing. For some reason, there's pages missing. Give me a second. I will open it in another window. Give me 1 second. Okay, there we are. Should be visible again, right? But a little big, maybe. There we go. So, we have the September results. In September, what happened was this. We had NQ, ES, and YM all going up nicely, right? With NQ being the leader in this case. So we saw NQ go up with around 6.06%, ES with 4%, and YM with 2%. So this one was lagging behind a little bit. So as I wrote down here, NQ led the monthly performance with a momentum driven advance and closed at new all-time highs, extending growth and AI leadership. Same with S&P, also setting new all-time highs, and the Dow Jones also did it. So overall, September was a trend up month with all three major US equity futures printing new all-time highs. And the relative performance hierarchy, NQ, ES, YM, kept index sensitivity tilted towards mega cap and AI adjacent names, while breadth improved across the large cap complex, right? So you can see that tech companies and AI adjacent companies are right now performing the best, and that's why NQ has gone up the most as well at the same time. Oh, I think it's loading. There. Then we have a multi-asset analysis where we basically look at all three pairs and see and we apply the IBDA lookback on it. Are you guys familiar with this, the IBDA lookback, 60-day lookback period? Type a 1 in the chat if you do not know what this is, or if you want a reminder of what this is. But I think it's a pretty straightforward concept that a lot of ICT traders use. Basically, we anchor this to the start of a new month. So in this case, it's anchored to September. And that way, we'll be able to see how September moves relative to the 60-day lookback, right? While also, at the same time, measuring relative strength across the three assets, right? We can use the lookback to monitor time-based liquidity pools and PDRAs from the last 20, 40, and 60 days. So it's basically 3 months. Because there's on average 20 trading days in a single month. If we don't include the weekends, it's 30 days, of course. And as you can see, NQ right here had a massive expansion, right? And just started to close higher. Then we have ES. And what we can see with ES is ES also had a big expansion. And basically followed up with NQ, but just percentage-wise, it was just a little slower. That's it. And YM is obviously lagging behind. As you can see, YM made a higher and failed to extend through, where ES and NQ were able to. So in this case, you can see that YM was the weaker one, right? Then we'll look at a monthly recap, where we're going to monitor the yearly development and the higher time frame. And this is a template that's also available inside my analyst section. If you want to take a look at it, I'll send a link in here. There. Basically, the chart layout allows you to see weekly candles, monthly candles, quarterly candles, and a yearly candle on the chart without the actual underlying price action. It just shows you these 4 sets of candles right there, right? So we'll be able to see the higher time frame development very quickly. And what we can see is that after 2 months of a controlled grind higher, which were these 2 months right here, we went higher, but it was very slow. We finally had a month where we expanded pretty much, or expanded heavily in September. And then finally holding above prior all-time highs, right? Because in the previous month we did break it, but we closed back down below it again. And that expansion left behind a buy-side imbalance, sell-side inefficiency, also known as a BISI. And in the weeks ahead, price can either partially refill that inefficiency before continuing higher, or if it does not retrace, the move can print a fair value gap that acts as a reference zone for future rebalances. What I mean by that is this is October, a screenshot from October when the month just opened. And in between these wicks, we have a little gap. And what we could have seen is the market trading into it or creating a gap that's pretty much open after October. And then we could see it go in afterwards, probably. Then a technical analysis. Using the prior swing range as a reference. So in this case, I look at this leading range and we project it upwards, right? Why do we do this? Because the market often moves in symmetrical ranges, right? So you can project them upwards, and then you have an expansion target if you are trading at all-time highs, right? In this case, you could see that when September ended, we had an exact measured move of exactly 1 standard deviation projection of the previous range, right? Where I was looking for the market to either take 2 conditions for continuation, which are either refuel through the imbalance, so trade into the imbalance here and continue higher, or maybe dig down deeper and search for sell-side liquidity within the range before going higher, right? There are 2 very easy ways to look at the market. Then we also look at the market from a stat map perspective, so we at least take some statistics into it as well. As you can see, stat map is plotted with both the median and the mean on the chart. And as you can see in the previous month, in the previous report, also we outlined that the market just traded into the bearish or bullish manipulation level right here, and we were looking for an expansion or a continuation of the move. And as you can see, we had a perfect outline there. So we got that good in the previous report. The market traded into the bullish manipulation and then started to expand significantly, right? Then I said, for upside continuation, a quick rate of internal sales of liquidity could precede a rotation back to the bullish level before continuing up, right? And if we had a sustained trade below the bullish manipulation level, it would tilt the bias towards bearish distribution, right? And it returned to prior sell side pulls. But as far as I know, just let me check the daily chart right now where we are at. That all didn't happen, and we've just continued to expand slowly. So far so good, and there's still nothing that says we're going to be massively bearish or anything. Then seasonal analysis. Is everyone familiar with what seasonal analysis is? This is also a premium tool, so you get some insights from a premium tool with this. Basically, seasonal tendencies are patterns that happen in the market every year, and we look at them from specific data ranges, such as 5 years, 10 years, 15 years, 30 years, or all time, all data. And usually, historically, October tends to be very bullish. As you can see here, the 5-year, the 10-year, and the 15-year all say that we're going to go up, and all-time seasonals also expect us to go up. So that means that as a roadmap it is, usually in October, NQ tends to go up, right? Then we also have the federal rate cut coming up at the end of the month, rightly. And the Fed's rate cut during the month likely contributed to this divergence as easier policy supported risk appetite and limited downside follow through. Because last month, seasonal wise, it's bearish, right? September would have been bearish on a seasonal scale. But in this case, we had a underlying fundamental driver that made sure we were not bearish at all, which is the rate cut, right? Which made sure NQ was continuing to go up. So in this case, you could see that we diverged from the seasonal. Then we look at the fundamental analysis. And in this case, we have the commitment of traders. I think most of you are probably familiar with what this is. I already talked about this in a few streams. If you have no clue what this is, I suggest to look at one of the earlier streams I did on my YouTube channel, where I basically did a full guide on how the COT works, how to use it with open interest, how to interpret everything, and how to use it in long-term analysis or medium-term analysis. So commercials typically run net short in index futures, right? Because it's part of their hedging program. And the changes in that net short, if is it deepening or is it covering, are more informative than the absolute level, right? Or if they are net long or net short. Across late Q2 through September, positioning trended less net short into a quarter end, while prices pressed new highs, consistent with a constructive but hedged backdrop. So what we talked about earlier. So net shorts reduced the most recently, aligning with September's momentum expansion to all-time highs. So what you can see is on the green line, that's basically the net position of commercials. And in this case, they closed a lot of shorts or they added longs, which basically adds more fire to the fuel. Fuel to the fire, sorry. For the bullish backdrop, right? And the bullish narrative. And overall, we can see that they keep increasing their buy positions over time. And it also supports the markets into going higher. Because if the big guys are into the market with size, markets can run on for much longer than expected often. Then we have open interest. And with open interest, we look at the outstanding amount of contracts that are in the market. And we can use this together with the COT to get a more accurate read on the current situation. So, and what we just saw is that on all three indexes or indices, the open interest plummeted pretty hard. You can see it right there, right here, and right here. But it's pretty normal because the end of the month is coming up or end of the quarter. So it's a contract roll effect, and the recent plunge in open interest reflects position closures. because the quarterly contracts will expire soon. So it's not a sudden shift in conviction. It's pretty typical. Every few months we'll have it, as you can see here. Happens every quarter. Then, so how do we then interpret the data? Well, we have to look at the trend. In this case, stripping out the expiration dip, the underlying open interest trend over the past few months has been stable to rising alongside price. So that means consistent participation from larger participants. So we have to monitor whether the open interest rebuilds promptly or not. A quick rebuild supports trend continuity, while muted rebuild would argue for slower participation and maybe even a shift towards balance. So to balance everything out, right? And then we have a page where I basically go in depth about explaining the COT plus open interest together, what it tells you, what story it tells you, a combined view of the COT. And I look at it through a Larry Wims lens, basically. So in this case, price rising together with open interest and commercials reducing short is a constructive mix, because it suggests that new buyers are joining a trend, while hedgers need less protection. And that description pretty much fits NQ and ES at the best. So a cautionary setup would be price rising, while open interest stays flat or falls after a roll and commercials start adding to shorts. That would hint at a more powered move by short covering than fresh demand. So for October, what I would say is keep an eye on three things: open interest rebuilding, commercials continuing to lighter their net shorts, and to see whether a YM's lighter hedging turns into stronger relative performance or simply a slower move, right? Because they're, as you can see on the COT, they're pretty much quitting, or not quitting, but they're toning down the hedging activity on YM. So it could either be that they expect a stronger move, or it's going to be even slower, right? Then we got the Forex markets September results. And as you can see, it's indeed pretty muted. DXY, Euro, and GBP barely did anything. They didn't even move 1%, not even 0.5% in the entire month. So it's pretty boring. The dollar was essentially unchanged. Euro just went slightly higher, and GBP USD dipped 0.39%. So not a lot happened in the Forex markets. As you can see, only relative strength. Almost nothing happened. We're still range bound in these markets. They were just going sideways. So not a lot of interesting activity in there. Both the euro and dollar did sweep the 60-day low and 60-day high, while GBP failed to do. So we got a SMT divergence on the top, as you can see here. So that could have led to potential downside on euro and GBP, and that's exactly what we're seeing right now. So the euro and the pound both are moving downwards after we saw the SMT divergence. Then a monthly recap, and we'll look at the higher time frame development again. And what you can see is pretty much that the weekly candles, there's nothing happening in here. It was pretty flat overall. Monthly candles, same thing, pretty flat overall. And then the quarterly candles is where it gets a little bit more exciting, and the yearly candle, because there we can see how the DXY basically had two very big quarters where it just slipped down, and afterwards, after you get a massive expansion, it's very likely that you get a consolidation, right? It's not weird, because of course, at some point the money is going to run out, and positions need to be rebuilt, markets need to be rebalanced, and everything before a new move gets fuel. Right? Then we look at the step map. And as you could see, in September starts here, ends here, where these overlap. You can see that the DXY was pretty muted. It just went sideways and it failed to go to either one of the statistical distribution levels. So it indicates a consolidating month, and we've been doing the same so far. However, DXY did start to expand now that the euro and GBP went down. So that's something good to look at. Then we also apply the seasonality analysis on this one. And as you can see, the larger data sets, so the 15-year 35-year, and all-time seasonal data suggested a consolidating bias, right? While the 10-year and 5-year suggested bullish bias. It was pretty much consolidating the entire time. And this month we kind of have the same bias or the same seasonal. It's consolidated and slightly bullish. And usually I tend to favor these long-term seasonals a little bit more. And as you could see right now on the chart, if you look at the DXY, this is exactly what's happening. We see the DXY going up since we basically opened in Q4. So that's good to see. Any questions so far, by the way, about anything of this? Let me know. So, let's see. Oh, I need to see someone typing, so I'll wait out the question. Can this be used in a fractal manner, so from week to week, or strictly month to month basis? You mean the seasonal tendency, or you mean the COT? The report as a whole? Well, I don't make the reports from week to week, so it's more from month to month basis as of now, and even a longer term as well. So it helps to basically see and understand what you can expect in the coming month, and not only the coming week. So more than that. Then we have the COT for both the dollar and the euro, and what we could see here is something that I have used a couple times, also on stream, where we see that the US dollar is basically trading lower, right? It's setting in a lower low, all while the COT is going higher. So basically that means that commercials are positioning themselves for more buys, so they're buying more at lower prices. So in turn, if someone is buying at a lower price, right, while creating a very clear liquidity sweep and a change in state of delivery, that could set us up for potential higher prices, right? Same thing on the euro, we see that the euro is going up and they're buying as well. So this is like a conflicted thing, right? Because they're showing bullish signs on their euro, but they're also showing bullish signs on the dollar as well. So as I write here, Euro USD rose while COT positioning also moved higher, which is confirmation rather than divergence. In Larry Williams' lens, price up with longs increasing showed sponsorship behind the move, and if the sponsorship fades or reverses while price stalls, the setup can shift towards a standard mean reversion Q, right? So that means the euro going lower. So based on the COT and overall price action, I was also able to get a swing position in on euro, and it's going pretty well so far, so happy with that. And then if we accompany it with the open interest, we can see that it has been rising both on the euro and on the dollar index, right? And from Larry Williams' perspective, the market going up with open interest going up usually means new participation is just joining the move, and it's not just short covering, right? And that fits Euro USD, where price advanced, open interest climbed, and a sign of sponsorship was behind the trend. But at the same time, if open interest gets too high, while there is a large trending condition, usually what will happen is that a large part of the people are on the wrong side of the move, because it's too late basically, and the market starts to reverse to its mean. So it starts to reverse either long term or short term. Could also just be on the short term, right, for a few weeks maybe. And that's also something I talk about in depth in the other video that I talked about, the other live stream. That's also on my YouTube channel. So how do we monitor next month? if Euro USD keeps rising while open interest rises, usually sponsorship remains firm, right? A stall on open interest or stall on the euro while open interest would be rising would kind of hint at a tug of war and a possible range. If the DXY begins to lift, so expand, while open interest stays firm, the accumulation rate gains credibility, and if price stays flat and open interest fades, the build was likely transitory and the range conditions persist. At this point, what we're seeing now is the dollar indeed going up, while open interest is also trending upwards. So that's a good sign for the dollar. So that's also part of the case why I took a sell position in the euro. Then I look at the COT plus open interest again. I combine them to see a broader view. And I actually basically said that if we see strength in the euro continue and we see the strength in the dollar continue as well, then it's pretty advisable to be careful on Euro USD if you are swing trading, because it could mean that the Euro USD would just go sideways, because if both are gaining strength, neither one is getting more valuable against each other, so they will just go sideways. And then it's more advisable to look at other exotic pairs or other pairs, cross pairs, that are fundamentally weaker than the euro or the dollar and trade those, right? Because that's where volatility will then kick in. Let's see. Then we look at the global interest rate climate, where we basically look at all the central banks and what's basically happening on the world as a whole in the whole global interest rate markets. And what we've seen in the last quarter was that basically all central banks started shifting towards easing, so basically cutting rates, except for one, which is Japan, and they are the only one that raised the rate to 0.5 in August. And they're basically the only central bank in the world, well, not the only central bank in the world, but major central bank right now that is increasing its rate rather than cutting it. Then we look at the bond market and we do the same thing as we've done on the other markets. And what I told you earlier is that the longer term maturities were a little bit stronger than the shorter term. And as you can see right here, it's ZB, which is the 30-year treasury, expanded and slightly retraced. Then we see the 10-year note that expanded and retraced a lot more. And then we see the 5-year note that expanded slightly and retraced a lot more. As you can see, we closed below these lows right there, and we're still above these lows on these two. So what that means, leadership from the long end points to a firmer bid for duration, while the front end remained more sensitive to policy repricing, right? And that means the shorter term notes, such as 5-year or 2-year, are more sensitive to short term interest rate cuts, right? Compared to the longer term ones. Then we have the US yield curve, and this basically gives an insight into how returns on bonds vary based on the length of time that an investor holds their treasury securities, right? And the yield curve illustrates the expected annual return for different maturities and helps you understand the interest rate trend and economic outlook as a whole. So the US yield curve still remains inverted around the 2 to 3 year area and then slopes upwards in the long term, right? In practice, this points to markets pricing easier policy ahead while still demanding compensation for longer term growth and supply risk, right? So short-term borrowing costs have started to ease for businesses and households with floating or shorter maturities. Because interest rates have been cut down, the borrowing costs have started to ease slightly. That's why these yields go down. But the longer dated finances such as mortgages and investment grade issuance remains relatively expensive because they've been done a long time ago, of course, when we still had a higher interest rate. So that's why these longer term bonds are still at a higher rate. A flatter inversion reduces recession signals, but it does not remove them, right? And it keeps asset pricing sensitive to small changes in inflation and labor data that we do not have at the moment. Let's see. Then I always build a intermarket dynamics dashboard, where you get a quick overview of what's happening in terms of order flow, seasonality, open interest, market condition, COT report, and the interest rate for all three asset classes, right? For NQ, for DXY, and the T-bonds. And light gray means the previous report, and in black it means the current report, right? So NQ went from bullish to sideways eventually, and now it's bullish again. Seasonality went from neutral. This should be bearish. It should be bullish. Sorry. Open interest is still rising. The market condition is expanding because we're still going higher. And on the COT report, we're still net short. And same goes for DXY and T-bonds. You can take a look at this, take a screenshot if you like to. And it basically helps you see the market conditions in a quick overview. Then, this is the end of the report. 34 pages, where we have some additional resources such as the 2 Degrees library, of course, the analyst section, the investor sentiment survey. So here you can look at the sentiment analysis on your own. And then we have, very importantly, the FedWatch tool. That's used to basically check up on short-term interest rate expectations in the market, right? And it's not only short-term, by the way, it's also longer-term, because you can look at future FOMC meetings and what the expectations are as of now. But I'd say just look at the closest one and maybe the one afterwards. It's not really interesting to look at the ones a year from now because we have no clue what the data is going to be by then, right? And then we always end the report with a conclusion. So you're able to see the whole development of the markets in a shorter piece of text, right? Any questions so far about the report, about trading, about anything else? I haven't taken a look at the markets just yet. Just still gonna do that as well. Let me see where NQ is up. What's NQ is up to? NQ is going down. Okay. Let's see. No questions so far. That's okay. I hope everyone maybe learned something today, saw something interesting, or maybe not. I don't know. That's the report as a whole. So now I want to leave the stream for if people have some questions, or if they want to look at something else, or if they want me to look at something specifically. Yeah, just go ahead. And otherwise, if there's nothing, we'll round up the stream soon. Let's see. No questions so far. All right. I think there's no questions. So I hope you all enjoy the stream. I hope I'll see you guys in the next one. Next time we're going to do probably a AMA. We're going to be looking at markets live probably. And the stream after that, we're going to be looking at trading psychology again, which is always fun. There's always a lot of people that tune into that one, which will probably be about... I'm not sure yet, actually. I think I'm going to run a poll inside the server, so people can choose what we should go over in the next psychology stream. And I'll make sure to prepare a presentation for that again. Overall, I want to thank you everyone for being here, and I wish you a nice trading day if you're going to trade today. If you're not, then if you're going to sit it out, that's also fine. So yeah, have a great one, everyone, and I'll see you in the next stream. Bye-bye.